Imagine starting with just a modest portfolio and, over time, turning it into $2.26 million. That's exactly what one Redditor did, and the secret wasn't some complicated trading hack or risky bet. It was all about dividends. Instead of chasing the next hot stock, they focused on consistent, reliable income from dividend-paying ETFs and reinvesting every penny back into their portfolio. What's remarkable is how simple it sounds, yet how rare it actually is. Most investors overlook dividends, thinking they're small or boring, but this strategy proves that small, steady gains can snowball into massive wealth over time. The Redditor's approach highlights patience and discipline above all else. But here's the twist. While this method worked incredibly well, it isn't without risk. Since it's tied heavily to the stock market, any major downturn could hit the portfolio hard, even with careful reinvestment. And that's just the beginning, because the ETFs they chose set the stage for a strategy that's both clever and surprisingly robust. The backbone of the Redditor's portfolio came down to two key ETFs, SCHD and DEVO. Each of them played a unique role in building steady income while keeping growth potential alive. SCHD, or the Schwab U.S. Dividend Equity ETF, is known for its mix of high-quality, high-yield U.S. stocks. It's designed to reward investors with consistent dividend growth while still offering the chance for capital appreciation. Essentially, it's a way to let your money work for you on autopilot, collecting income while the market does its thing. Then there's DEVO, the Amplify CWP Enhanced Dividend Income ETF. This one adds a twist with a covered call strategy, meaning it aims to generate higher income from dividends without taking on excessive risk. For someone focused on long-term growth, it's a clever combination: steady payouts plus an extra layer of potential profit. Together, these ETFs created a foundation that was both simple and effective. By consistently reinvesting dividends back into these funds, the Redditor allowed compounding to do its magic, turning modest gains into a portfolio worth millions. But choosing the right ETFs is just the start. Knowing where and how to invest can make all the difference, which is exactly what the Redditor did next. Once the Redditor had their core ETFs, the next step was making investing easy and efficient. That's where platforms like Public come into play. Public isn't just another trading app. It offers commission-free trading and even a high-yield account where you can park cash between investments, letting your money earn while you decide your next move. But the real game changer is its social features. You can follow other investors, see their strategies, and learn from their successes and mistakes, almost like having your own mini Reddit for investing. It's a way to stay informed and inspired without taking unnecessary risks. Of course, not all advice is created equal. The Redditor didn't blindly follow every tip they saw online. Instead, they combined community insights with credible research-backed platforms like Moby, where former hedge fund analysts break down stock picks in an easy-to-understand way. With the right tools, even beginners can start building a portfolio that's both smart and strategic. Platforms and communities can give you ideas, but disciplined decision-making is what separates casual investors from those who actually hit seven-figure milestones. And that discipline led the Redditor to explore ways to diversify beyond just ETFs, which is where things get even more interesting. While SCHD and DEVO provided a solid foundation, the Redditor knew that true stability comes from diversification. Relying solely on dividend-paying stocks, even in multiple ETFs, can leave a portfolio vulnerable to market swings. That's why they explored alternative investments beyond traditional stocks. One of the most accessible options is real estate. But owning a property outright isn't the only way to profit. With rising home prices, median U.S. homes hitting over $410,000, and higher mortgage rates, many investors are turning to platforms like Arrived, which allow you to buy stakes in rental properties with as little as $100. You can earn rental income without the headaches of tenants, repairs, or property management. These alternatives create passive income streams that complement dividend ETFs. By spreading investments across stocks, real estate, and other asset classes, the Redditor reduced risk while still keeping growth potential high. The lesson is clear. Diversification isn't just a buzzword, it's the shield that protects your portfolio when markets get rough. And the story doesn't stop there. Some investors go even further, exploring hands-off real estate strategies that offer high returns with minimal involvement. That's where things like home shares and commercial properties come into play, which we'll explore next. Beyond traditional rental properties, the Redditor and many savvy investors looked to hands-off real estate options for stability and growth. One example is home shares in the U.S. Home Equity Fund, which lets accredited investors gain exposure to hundreds of owner-occupied homes in top U.S. cities without the stress of managing property themselves. These investments focus on homes with substantial equity, using home equity agreements to help homeowners access cash without adding debt or interest. For investors, this translates into a low-maintenance, income-generating opportunity with risk-adjusted returns ranging from 14% to 17%. Commercial real estate is another avenue. Firms like First National Realty Partners, FNRP, specialize in grocery-anchored retail spaces leased to essential retailers like Walmart and Whole Foods. These properties offer more stability during economic downturns, making them a solid addition for investors seeking both security and passive income. The Redditor's strategy highlights an important principle. Diversifying into real estate doesn't mean buying a house. It means finding creative ways to earn reliable income while minimizing hands-on work. And if you think that's impressive, the story only gets more interesting when we explore other alternative investments. The Redditor didn't stop at stocks and real estate. They also explored creative alternative investments to further diversify their portfolio. One surprising option? Fine art. Historically, art has performed well even during economic downturns, acting as a hedge against stock market volatility. According to the Fine Art Group, art has returned around 14%, outperforming the S&P 500's annualized return of roughly 11.88%. But buying million-dollar paintings isn't realistic for most investors. That's where Masterworks comes in. This platform allows investors to purchase fractional shares of blue-chip art by world-renowned artists like Picasso, Basquiat, and Banksy. You browse the collection, pick your shares, and Masterworks handles all the logistics, from purchase to eventual sale. When a painting is sold, you receive a portion of the proceeds, making high-end art accessible and effortless. With more than 60,000 investors in the community, Masterworks also provides data-driven insights to help you choose which artworks to invest in. This approach shows how thinking outside traditional stocks can create new income streams and add resilience to a portfolio. The Redditor's journey demonstrates that when it comes to wealth building, sometimes the best opportunities lie in the unexpected. The Redditor's journey to $2.26 million highlights a simple but powerful lesson. Strategic reinvestment and patience can turn modest investments into life-changing wealth. By focusing on dividend ETFs, consistently reinvesting income, and exploring alternative assets like real estate and fine art, they built a portfolio that's both robust and diversified. The key takeaway isn't just about following someone else's path, it's about crafting a strategy that works for you. Dividend stocks provide steady income, real estate offers stability, and creative investments can hedge against market swings. Together, these choices create a portfolio that can withstand volatility while still growing over time. So, what can you do with this insight? Start by examining your own investments and consider how consistency, diversification, and creativity can strengthen your financial future. And here's a question to leave you thinking. If you had just $100 to invest today, where would you start your journey to building wealth? The Redditor story shows that the path to financial success doesn't have to be complicated. It just takes smart choices, patience, and the courage to explore new opportunities. Before you start your own portfolio, here's a question that might change how you think about investing. What if the next Redditor you follow isn't the one with the strategy? You are. The truth is, these stories show possibilities, but the real power comes from crafting a plan that fits your goals, risk tolerance, and creativity. Imagine combining dividend ETFs, hands-off real estate, and even alternative assets like art or commercial property. The potential isn't just in the returns, it's in the freedom and confidence that come from knowing your money is working for you. So here's the challenge. If you had $100 to start today, which strategy would you pick first? And why? Think about it. Experiment. And maybe your story could be the next one that inspires thousands online.